Intuit just posted double-digit growth in their absolute deadest seasonal quarter, comfortably beat earnings, and their reward was getting violently hammered by the market. So, it's August 25th, 2026, and welcome to Earnings Unscripted. I'm looking at Q4 for Intuit, ticker INTU, and Miro. I'm slightly dizzy. They hit $4.35 billion in revenue, which is, up 14% year over year, yet the stock just fell off a cliff.
Right, because the market's, it's completely ignoring the rearview mirror on this one. Q4 was fine. Non-GAAP EPS was 403, way above expectations, but the tape is entirely about the forward look. The stock gapped down hard right at the close and just kept bleeding through the extended session, closing down, I think, about 13% by the time management actually wrapped up the call.
A 13% haircut for a legacy software giant is just brutal. And since we're staring at a massive post-market drop, I should quickly clarify, this is purely our own mildly obsessed take on the filing. So don't base your actual trades on our chatter. But, if the rear view looks solid, what specifically in the guidance broke the narrative?
It's a reality check on their pricing power, mostly. They issued their fiscal 27 guidance, and they're modeling a pretty sharp deceleration. Total revenue growth is expected to drop into the 9 to 10% range, which, if you think back to last quarter, we talked about them getting eaten alive by free tax apps at the entry level, right?
Yeah, the whole "we lost on price" confession with TurboTax. Wait, so are they still bleeding users there?
They're stopping the bleeding by finally throwing in the towel on price. The CEO literally said they're deliberately accepting lower initial pricing on the DIY tax side just to retain those users. When a premium SaaS brand essentially admits they have to buy market share back by compressing their own revenue per customer, the street instantly reprices the whole model.
That's not exactly what investors want to hear when you're heavily leaning into the whole premium AI ecosystem story. But hold on, if they're actively sacrificing margin at the bottom of the funnel and growth is slowing, then why on earth are they choosing right now to voluntarily nuke their own adjusted earnings? Because this note about stock-based compensation next quarter, it looks like they're stripping away their biggest accounting shield on purpose.
That's exactly it. They're officially yielding to the critics on this one. Starting next fiscal year, they're baking share-based compensation straight into their core adjusted earnings.
Okay, wait, walk me through the mechanics of that, because stock comp doesn't actually drain their cash reserves, right? So are they just shuffling accounting categories to look noble, or is there a real-world penalty here?
It's technically a paper shuffle. The cash in the bank stays the same. But the optical penalty is massive. For years, tech investors have mocked companies for treating stock options like monopoly money to artificially pump up adjusted profits. Intuit just pulled the plug on that game.
Right. So their future margins are just going to look significantly worse on paper.
Much worse. We're talking about a line item that was roughly $507 million just this past quarter alone. Shoving that back onto the profit and loss statement forces a brutal optical reckoning. The CFO actually admitted on the call, "We view share-based compensation as a recurring component of our compensation program and believe including this expense in our non-GAAP financial measures reflects our core operating results."
Basically admitting the skeptics were right all along. It's a very real recurring expense.
Exactly. And honestly, it takes genuine confidence to reset the baseline like that right as your overall revenue growth is slowing down.
Which brings me to the operational side of things. If they're tightening up how they report those compensation costs, where else are they cutting? We've heard so much about their grand AI pivot. Are humans paying the price for that transition?
Yes, in a very measurable way. This is where the whole AI transformation narrative hits brutal reality. They finalized a $293 million restructuring charge this quarter.
Right. That was almost entirely severance and site closures, wasn't it?
Yep. They're actively axing traditional roles to free up capital. They want to double down on hiring specialized engineers to build out this Intuit intelligence platform. The long-term goal is to shift from just logging your numbers to actually having an agentic AI chase down unpaid invoices for small businesses automatically.
That sounds incredible for a pitch deck, but swapping out your staff for virtual assistants doesn't necessarily mask the parts of the business that are genuinely struggling right now.
No, it doesn't. And the market knows that. That's why the Mailchimp situation is so interesting. They're finally peeling it out of that massive global business segment and isolating it as its own reporting block.
Okay, hold on. They spend billions acquiring Mailchimp, and hiding it in a bigger segment seemed like a highly convenient way to cover up any sluggishness. Why isolate it right now?
Because the music stopped. They have to rip the Band-Aid off. The guidance they just dropped for Mailchimp projects revenue being flat to down 1% next year.
Wow. So they're putting it in a glass box right as the growth goes completely negative.
Right. And the specific reason management gave is fascinating. They cited higher effective prices being offset by increased churn.
Meaning they hiked subscription fees and businesses just canceled their accounts.
Pretty much. They squeezed the lemon too hard. You boost the monthly price to make the revenue look better in the short term, but you erode your own customer base. And honestly, it's the exact same dynamic we just saw with TurboTax at the bottom of the funnel. Price is becoming the absolute breaking point across their portfolio.
It paints such a conflicting picture of the company. On one side, they're surrendering margin on entry-level tech software to retain volume, but then aggressively hiking prices on Mailchimp until they literally drive users away.
All while firing hundreds of people to bet the future on autonomous AI workflows.
And simultaneously nuking their own adjusted earnings optics just to finally give investors honest accounting.
It's an incredibly heavy strategic load to ask Wall Street to carry all at once.
Right. So if their core legacy products are actively bleeding volume due to price fatigue, can these new AI tools actually generate enough tangible value to reverse that exodus?
That's exactly the multi-billion-dollar gamble. Management clearly believes they can. The whole strategy relies on shifting away from selling basic software subscriptions and instead selling an AI system that actually does the heavy lifting for you.
Which makes perfect sense in theory, right? But retraining an entire user base to trust an automated agent takes a lot of time. Did they give any timeline on when this grand pivot actually starts padding the outlook?
They didn't. In fact, they're explicitly telling Wall Street to brace for a slowdown while they execute it. For their fiscal 27, management guided total revenue to grow somewhere between 9 and 10%.
Okay, right. And that's a fairly sharp deceleration from the growth rate we discussed a minute ago. So they're effectively planning for a massive transition year.
Exactly. And honestly, even that cautious guide relies on some fairly generous baseline assumptions. They built this entire forecast assuming total IRS tax filers remain completely flat next year. If the broader economy wobbles or the government's own free filing portal catches on, that narrow growth window could close very quickly.
So they're basically hoping the outside world stays perfectly still while they rip the engine out of their own business model and replace it with AI. You kind of have to respect the ambition.
It's definitely a bold play. If they actually pull it off and successfully cross-sell these advanced tools to their higher-value users, the long-term margins will be fantastic. But the execution risk over the next few quarters is just extraordinarily high.
It really is. We'll definitely be keeping an extremely close eye on that user turn next time around. Well, I think we've unpacked enough of this transition story for one day. Thanks for walking through it with me, Miro.
Always a pleasure. See you next time.
If these quick debriefs are helping you make sense of the noise, you might want to hit follow in your player. It's always worth mentioning that this entire show, including our synthetic voices, is an AI experiment in turning complex filings like Intuit's heavy Q4 restructuring drop today into a listenable chat on the exact same day. We really love your thoughts or ticker requests. So drop us a line at earningsunscripted@datamadness.ca or find the X link in our show notes.
Talk soon.